Hi everyone, welcome to today's video. So let me first and foremost take you to the chart of Nifty 50 and show you a very interesting point. So consider any two periods between a bull run. For example, this entire phase started from 2009 all the way till here, and the total return was roughly 150% in this bull run. Now you must have often heard the point कि यार आप long term के लिए invest करके छोड़ दो, that you just put your money in the long term and you will see the portfolio grow. Great point, and most of us would know this point already, but we still keep on making a lot of losses in the stock market. Why is that? I would encourage all of you to pause the video here, think about it and comment below in the comment box. Why do you think that happens? The answer is right in front of you. So I hope that you at least had a chance to think about it. See, everyone knows that the market is going from point A to point B, no doubt about that. But take a look at these periods, 1, 2, 3, 4. There have been at least 4 periods when the market corrected by more than 10%. And every single time we see the market getting corrected by 10%, hi, bear run aa gayi, hi, khatam sab kuch, right, वगैरह वगैरह, right? And as a result, we panic, we sell our stocks, and then we keep on sitting at the sidelines. The market gives a run up, and it becomes almost close to impossible for us to re-enter. Why is this happening? Well, the core reason for this is the fact that most of us do not know what is the meaning of hedging and how to hedge our portfolio. That is the precise topic that I am going to help you understand in very simple, easy to understand language. Some of the concepts might be a little bit convoluted because I might speak about what are market linked debentures, what are call options. So ये थोड़ा सा complicated लगेगा, but I will try to simplify it a lot. Do consider pressing the like button. A lot of preparation has gone into making this video. So just a simple like from your side will help these type of videos reach out to more investors. Also a big shout out to our sponsors for today, which is Incred Money. More about them subsequently on the video. So let us kickstart our conversation and let us first and foremost understand what is the meaning of hedging and what you can typically hedge versus not. For example, kids who are in class 11th, 12th, almost all of them who have taken engineering would be preparing for IIT JEE, right? And as a hedge, what do? They also take the exam of AIEEE. Ab bhai, kisi ke parents are very rich, so probably private engineering college, whatever it is. So the point is that these are hedges, AIEEE, private engineering college, vagera vagera. So I hope you got the concept of what hedging means, that you understand ki bhai dekho, IIT clear karna is really, really tough. So let me have some plan B that reduces my risk in case I am not able to clear an IIT. ऐसा ना हो कि मैं कॉलेज ही ना जा पाऊँ, right? So that concept is called as hedging, and something similar happens in the stock market also. Now in the stock market, there is a concept called as systematic risk and unsystematic risk. Now the concept here is that you can hedge the unsystematic risk, you can't hedge systematic risk. Now what is the meaning of this? अब इसमें complication में नहीं जाना है. We will understand it in very simple language. See, the point being that let's say that if Nifty 50 falls by 30%, so no matter what you do, the chances are that your portfolio will also fall. For example, my portfolio might fall by 20%. Your portfolio might fall by 30%. Someone else's portfolio might fall by only 5%. So on and so forth. But portfolio sabka girega. It is very, very likely. So what is the difference between a person whose portfolio is going down by 10% versus a person whose portfolio is going down by 20%? Well, the answer is that this person might have hedged his or her portfolio really well. So now comes the natural question that, okay, how can we develop that acumen that if the Nifty is going down by 30%, what is it or what specific techniques we can use that our portfolio only goes down by 10-15%? So can you talk about some techniques, some specific strategies that we can apply? So let me start discussing 8 such strategies. So the first strategy is called as margin of safety. So let me speak about an example that I gave on my member community channel, and it had to do with the PSU banks. So let me first and foremost show you where currently we are on Nifty 50, and you will see that we are almost at our all-time high. थोड़ा बहुत नीचे ऊपर होता रहता है, right? But we are at that 19,500 level, and this is a recent, almost a recent high, so to say. Almost the Nifty touched 20,000, it came back down, and now we are hanging around somewhere around 19,600 as of today. So Nifty 50 is almost at its all-time high. Now, if you say that, you know what, मैं तो निफ्टी में निवेश करूंगा, राइट, एंड आई एम गोइंग टू गो एंड इन्वेस्ट ऑल माई मनी इन निफ्टी 50 राइट नाउ बिकॉज निफ्टी 50 ऑलवेज कीप्स ऑन गोइंग अप. Yes, that is true, but the problem here would be that you are buying Nifty 50 here. And if you are doing bulk investing right now here, then it might happen that there can be a time correction. Nifty might dance around like this, right? It can go up, it can go down. So a lot of time will go away before you start seeing returns on your portfolio. Why? Because there is no margin of safety here. Let me give you two counter examples to this. That for example, now check Nifty IT. Now, if you have been a regular viewer of my channel, I had been giving the example of Nifty IT since the time it was here. It was outside this channel, right? And now it has re-entered this channel. And right now, if you see that if we extend all the way to the peak, there is still a 27% gain to be made simply if Nifty IT, entire IT index, just reaches its previous recent high. So there is almost a 27% margin of safety on IT stocks. Now, I am not saying that this is guaranteed that you are going to make 27% returns. Yeah, in the short term, the Nifty IT is not going to correct. It very well might be. But unless some macro data tells you कि कुछ बर्बादी हो गया IT में, that IT industry is not going to come back at all. Please notice the fact that I am not speaking about individual IT stocks, TCS, Infosys, this, that. No, I am speaking about the entire IT index. Now, if you are of the viewpoint कि भाई IT industry is not going to survive only, right? It will continue to go down, right? There is something fundamental wrong within the industry. Unless you have clarity on that specific reason, any sensible person would think कि यार ऐसा कुछ भी नहीं है that IT industry is going to get crushed. IT industry is likely to come back, right? And by how much it should ideally come back? It should come back up by at least 27%. Maybe it will take 1 year, maybe it will take 2 years. Even if you assume 2 years, right? Then also you are making 13% CAGR on IT industry. Why? Because of the fact that there is margin of safety involved. In a more realistic case, now consider the case that right now we are at 19,500 Nifty levels and Nifty goes up by 15%. How much do you think that IT industry will go up by? Will it go up by more than 15% or less than 15%? My bet would be that it will go up by more than 15%. Why? Because of the concept of margin of safety, that everything seems to be okay, or at least सब कुछ बर्बाद नहीं हो गया IT में. It looks okay. Whatever bad news had to come out, it has come out. So from that perspective, I am bullish on IT. Why? Because of this margin of safety concept. And if you want to hedge your portfolio, then first and foremost, buy things or buy good things that are at a discount or at a margin of safety. Let me give you another very quick example here that I had given on my member community. And this had to do with PSU banks. So for example, if you consider PSU bank here, this is as of today. And if you consider it back in 2018, ऑलमोस्ट सेम लेवल पे चल रहे हैं PSU बैंक्स का इंटायर इंडेक्स, राइट? सो इफ यू आर पिकिंग सम गुड PSU बैंक्स, फॉर एग्जांपल टुडे आई पिक्ड द इंडियन बैंक एंड इन जस्ट वन सिंगल डे इट गेव अ रन अप ऑफ रफली 12%. नाउ द रीजन अगेन देयर इज अ लॉट ऑफ मार्जिन ऑफ सेफ्टी ऑन PSU बैंक्स. व्हाई? चेक द रिजल्ट्स ऑफ एनी मेजर पब्लिक सेक्टर बैंक, बी इट पंजाब नेशनल बैंक, कैनरा बैंक, स्टेट बैंक ऑफ इंडिया, ऑल आर सेटिंग ऑन देयर हाईएस्ट एवर रेवेन्यूज, हाईएस्ट एवर प्रॉफिट्स. सो ऑल गुड थिंग्स आर हैपनिंग ऑन दीज बैंक्स. Bank cleanup has already happened. Then why is it that these PSU banks are not going to give results? They are likely to give results. So from that particular perspective, there is massive margin of safety or even something like PSU bank. So the next way of hedging your risk is to buy an option. Now, I'm not trying to tell you that you should become like an FNO trader, all this stuff. No, I'm not talking about options from a trading point of view. I'm talking about options from a risk hedging point of view. Now, what is the meaning of option? So this can get a very complicated topic. Let me break it down in very simple terms. What is the meaning of option? Option in Hindi is called as vikalp hona, and in English it is called as having alternates. So that is the meaning of having options. Now, if you contextualize it to the finance market, then there are two types of options that are there. One is called as call option and the other is called as put option. So let us quickly touch upon what call option means, and then I will tell you how you can hedge your portfolio by using these options. So let me first and foremost tell you the theoretical definition of call option and just read through this. That call options are financial contracts that give option buyer the right but not the obligation to buy a stock, bond, commodity, other assets at a specified price within a specified time period. Okay, कितने लोगों को बात समझ में आई? Okay, so this might be a little bit complicated, but here are 3-4 key things that you need to understand. So let me break apart an example for you, a real example, and then I will tell you the utility of call option. So okay, so I have picked this screenshot from my trading account, and this shows the call option for HDFC Bank. How can you check that this is the call option of HDFC Bank? Because this is the underlying here, HDFC Bank. And August is the expiry. Expiry means ki this option is valid only till end of August or last Thursday of August. And the exercise price or the predetermined price or strike price is 1570. C means call option, and 550 is the total lot size that you will have to buy. You can't buy just one option. Just one option खरीदना है. No, you can't do it. You have to minimum buy 550 quantity. So this is what an option looks like. And in order to buy this option, you will have to pay a 90.65 rupee premium on per quantity basis. Now you'll say कि अच्छा ठीक है ये तो सब आपने बता दिया. What is the utility of it? Okay. So here is the first key point about a call option. That a call option gains value when the market or the underlying goes up in price. Now, for example, consider that I am making this video on 10th of August, right? And HDFC Bank's stock price is 1650. Now, if by the end of August, let's say 27th of August, if the stock price of HDFC Bank goes up to, let's say 1750, now if such a scenario plays out, then it is my benefit that I am holding this option. Why? Because here in this scenario, the example that I just shared, how much profit will I be making? I'll be making 1750 minus 1650 minus the premium or the insurance price that I have paid, 19.65. So I'll be making some positive profit on this. So to cut the long story short, a call option is beneficial if the asset or the underlying is going up in price. Opposite happens with a put option, that if you are scared कि भाई साहब market नीचे जाने वाला है या HDFC Bank is going to go down, then what should you buy? You should buy a put option because it is somewhat the opposite. A put option protects your downside risk. A call option protects your upside risk. So I hope that you got at least the basic flavor of what a call and a put option means. In case you want to learn more about it, I had done a separate video on this topic. Please go and watch it. I have done a much more detailed explanation of what is the meaning of option. But at least for this video, I'll assume that you got the basics. Now, the situation that you might have witnessed is that when you are buying a call option or a put option, you will have to, number one, understand which option to buy, what expiry to buy. Quantity size is huge. जैसे मैंने आपको HDFC Bank का had shown you, it's like 550 lot size. So it's a huge lot size, lot of investment from that perspective. So what can you do as a normal retail investor? Well, you can go and purchase something called as MLD or market linked debentures. They use a strategy of investing money in debt and then buying some kind of call or put option or using a straddle strategy. Straddle strategy means कि उन्हें call भी खरीद लिया, put भी खरीद लिया, अलग-अलग expiry के, all that stuff. That becomes hyper complicated. We will not get there. But let me explain what MLD is, and that is the next hedging strategy. So the theoretical definition of MLD is this, that market linked debentures are type of a debt instruments that offer returns based on the performance of underlying market index or instrument. Okay, so again same story, बहुत complex definition है. So let me break it down and help you understand it in a slightly more easier format. See, the meaning of debenture net is equal to a bond, right? So there are two types of market. For example, there is an equity market, bond market. If you're going and buying an ITC stock or equity, what are you buying? You are becoming a part owner in the company. But on the flip side, if ITC comes out with its bond, right? And they say that, you know what, we are going to pay you 9% yearly return on this bond. Give us certain amount of money. So you'll go and invest probably like 5,000 rupees in it and you'll make like 9%. So are you a part owner via the bond market? The answer is no. You are simply giving money on loan to ITC via this bond / debenture. So market linked debentures are what? Well, they are a type of a debt or a bond instrument which is linked to the market. Now the market here could be Nifty 50 or it could be underlying gold prices or it could be anything underlying, the way I explained you for a call option. Now let me give you a live example of an MLD, how it is designed and whether or not it might be sensible for you to go and purchase this MLD. By the way, this MLD is open for subscription. So in case you are considering investing in this particular MLD that I am going to speak about, you can check the links in the description and comment box. Now this MLD is by a company called as Incred, and this is a principal protected MLD. Now what is the meaning of principal protected? So principal protected simply means that if you have put in 100 rupees, then you will get 100 rupees back. That in case the worst case scenario happens. Now let me quickly speak about that how this MLD is designed. For example, here you are putting 100 rupees, 5 goes into a market linked component where a call option is purchased. Now that call option price at expiry could range from between 0 to 16 rupees. So this is the return that you will make on the call part. Rest 95% is put in a debt instrument, and after 2 years you will make 114 rupees. So please note that this is on a 2-year basis. This is the term of this MLD, that in 2 years you can make a minimum of 14% returns or a maximum of 30% returns. So in case you are interested, you can purchase this MLD on Incred Money platform. Now you'll say, can you explain the math, how this 30% is attainable and under what circumstances is the 30% attainable? So for this, you need to understand the payout matrix of any MLD. Now, whichever MLD you are trying to hedge your portfolio with, do try to understand its payout matrix. So here I will give a very quick explanation of the payout matrix. So see, we started the video by speaking about the fact that the Nifty is going to correct at some point and you might get scared. So here what we are trying to do through this MLD is that we are trying to protect our downside. So if you look at the negative return scenario, right, that if Nifty falls from 19,500, where we approximately currently are, all the way to 15,600, then Nifty returns will be minus 20, but MLD returns will be 14%. Why? Because money, or a significant part of that money, is invested into debt, right? Similarly, if you read through this entire case, right, you will see that even when market is giving 0% return, your MLD return will be 14%. Now this MLD is also quite favorable in a Nifty mildly bullish scenario, that if Nifty is somewhere around 23,400 in the next 2 years, then also in this MLD you are not losing any money. Finally, you lose money in a bullish scenario on this MLD, that for example, if the market touches 27,300, then Nifty returns will be 40, but your MLD return will be 30, right? So if the Nifty crosses 25,350, then only in that case you're losing money. But if you have put in some amount of money in Nifty, then वो part तो आपका positive return देगा ही. Even MLD part is giving you positive return. The good thing about the MLD is that it is protecting your downside. So this is a hedging strategy. And if you feel that you need to hedge your portfolio, then you could consider this MLD. Now the final part about this MLD is the bond part, that what if the bond goes bonkers, right, and the bond falls to 0? Is that possible? Is that not possible? Well, here are the ratings by independent agencies, and if you are okay with the risk, then this is an option that you could definitely consider. So with that said, let's move on to the next section. Okay, so the next hedging technique is called as balancing your portfolio with aggressive and defensive stocks. Now what are aggressive stocks? So these would be IT, tech, these could be banks or finance. If you are picking in more small finance, then what are you typically doing? You are buying more aggressive stocks. These stocks are likely to have something called as higher beta. Now, it might very well be the case, for example, आप मेरी तरह हो, right, and almost 60-70% of your portfolio comprises of finance. Now, this type of portfolio does exceptionally well when the markets are going up. But if you do not balance this portfolio with defensive stocks, for example, FMCG, Hindustan Unilever हो गया, Nestle हो गया, all these different companies, these are defensive companies. They do not aggressively go down in value, generally speaking. So if you're not playing this balancing game, that you have enough of defense with a mix of aggressive, then the chances are that you are not hedging your portfolio properly. Now, this is a balancing technique of hedging. Now, many investors, for example, Mr. Vijay Kedia, he buys highly aggressive small cap companies, right? And I don't think he balances by using any defensive stocks, so to say. So this is not something that he would believe in. But yes, as a normal retail investor, I would highly encourage you to balance your portfolio by buying aggressive and defensive stocks both. Because typically what you might have yourself noticed was that in 2020, when crash came, what type of stocks did not go down crazily in value? It was something like Hindustan Unilever, FMCG stocks. Why? Because these were defensive in nature. So therefore, it is always advisable that you have some defensive stocks in your portfolio, or you have some kind of debt exposure to your portfolio. So the next hedging strategy is called as cash averaging strategy. Now, what is the meaning of this? So let's assume that you already have, as of today, 10 lakh rupee invested in the entire stock market. Your portfolio is fixed. You're happy with it. Now what is happening is that you are making, let's say, additional income of 1 lakh rupee that you can invest in the stock market, right? So what needs to happen is that you need to make a call as to how much equity you need to keep versus how much cash positions you need to keep. Now, typically what we do is that in a growing market, we keep on doing SIP. There is nothing wrong with it. It's fine, right? I mean, it might not give you the best possible results, but SIPing at least gets you in the habit of making investments. But I would personally recommend, and this is an advice that I also follow, that for example, you must have something called as cash reserve. For example, out of this 1 lakh, take out like maybe 15% of this money and create a separate fund, right? And call it the bear market fund, right? Bear market fund, right? Now, when 2020 like situation comes, when a major correction happens, ki 20% correction ho gaya hai, yeah, I have already shown you that 10% correction will keep on happening in the market, right? Even in this market, it will happen. So from that perspective, this is the fund that needs to go here because this fund is going to give you the best CAGR. So I would always recommend that whatever new money you are putting in the market, and if you have a big portfolio already, then timing the market intelligently becomes critical, and having a little bit of cash reserves that you're pulling out of this new fund, especially when you're sitting on a big enough portfolio. Just say I started the story by saying that you're happy with this 10 lakh. Now, if you are in very early stages of your portfolio banana shuru hi kiya, you're 22, 23, 25, very young, then honestly this technique does not apply to you, right? Because you have a fairly long investment horizon. But this technique becomes especially important for people who are slightly older, right? If you're 40, 45, 50 plus, then having some cash reserves become critical for you because it can allow you to hedge in a falling market, that if the market falls by 10%, you invest more money into the market and then your losses becomes how much? Then it will fall down to 8% or whatever that percent is. So that way you are able to lower your losses. So okay, so I wanted to teach a few more techniques, but unfortunately we have run out of time. What I'm going to do is that tomorrow on the member community tab, I'm going to depict more of these techniques and I'm going to talk about some more techniques. Investments in debt securities are subject to market risks. Read all offer related documents carefully. You can ask me your questions there also, and I will try to respond as many questions as possible. One good video to watch here is the FNO video. Please go and watch it. It will give you more understanding on what is the design of call option, put option. And please do not become FNO traders. That is a humble request from my side. Most of the FNO traders lose their money. So don't play that game. But yes, do understand that you can use futures and options in order to hedge your existing portfolio. Thank you so much for watching, and I'll see you soon.